Yeah, big minute. Yeah, big minute. But if you think about slacking off with Primerica, you still make six figures. Slacking. I slacked off for the last 2 years. Still make six figures slacking. That's a different level of slacking, ain't it?
Right.
Yeah. But now it's trying to get grinding. All right, so chapter 6 and the final chapter, guys, of your licensing class. And this is going to talk about life Missouri statute rules and regulations pertinent to life insurance only. So we're going to start at page 108 in the book, and we bring this thing to a finish line. So policy replacement. So this is when you're dealing with clients we come to see you tonight, Mr. Vincent. So I'll use you for an example. So you all got policies already in place. Mm-hmm. We getting rid of those policies and putting Primerica in place. That's called a replacement. So there's certain rules that you got to follow whenever you're doing a replacement. Right? Mm-hmm. Why? Because the law is intact to make sure that the best interest of the client is what's being honored, not me just making a commission. So in order to do a replacement, I have to make sure that I prove this in the best interest of the client. So there's certain duties that you as the replacement agent have or producer, and then there are certain responsibilities of the company. You got to know what your responsibilities are, and you got to know what the responsibility of the company that you work for are. So duties of the replacement producer, that's you. He got to present to the applicant a notice regarding replacement that is signed by both the applicant and the producer. A copy must be left with the applicant. So in other words, we're going to sign a form saying we replacing what you got. Mm-hmm. And we're going to leave that form with you. It's going to be electronic. You're going to get an email, but that's what has to happen. We got to say, we understand that we getting rid of what you got to give you something better. The second thing is we got to obtain the list of all the existing life insurance and or annuity policies to be replaced, including the policy numbers and the name of all the companies being replaced. So we got to take down who you with and the policy numbers. The third thing that we got to do as agent is leave the applicant with the original or a copy of a written printed communication used for our presentation. In other words, we got to give you a form saying this is what we're giving you. A notice saying we're going to get rid of what you got. A copy saying this is what we're going to give you. And we made a list of everything that we're getting rid of. Then the fourth thing is we got to submit the replacing insurance company a copy of the replacement notice with the application. So then after we get this information from you about the company you're with, the policy number, who all being replaced, we left a copy with you, then we got to take a copy and give it to Primerica. Mm-hmm. That's what our job is. Get all that information about the company you was with, the policy, the policy number, the person that was insured, and then we get you a notice saying we're going to get rid of this and give you something better. Once we get all that, we got to now send it to Primerica. Because Primerica is the company that's going to be replacing another company. Our job ain't to get the information to the other company, telling them we're getting rid of your policy. Our job is to get the information, get it to Primerica. Now, Primerica is our insurer. Mm-hmm. So their job is to get it to the other company. That's the job of Primerica, is to request you to bring the information. And then once you bring the information, they got to send it to the other company. By law. You can't replace another company's policy without letting them know that you're doing it. Because you got to give them a chance to come back and say, wait a minute, hold on, they screwing you. We gave you something good. They finna mess you all up. Mm-hmm. It gives them a chance to make sure that the best interest of the client is what's being considered. Does that make sense? Because if I'm an agent and you replace my policy, I want to come back because you're taking money off my table. Mm-hmm. Let's roll our sleeves up. Let's see what he lied to you about, because I sold you the best thing that's out here. Right. Does that make sense? Mm-hmm. So that's the deal. You're responsible for getting the policies, the policy numbers, a notice of replacement, and take that information to your company. Your company is responsible to tell you to do that and then send it to the company that is being replaced. That makes sense? Mm-hmm. So that's the duty. You got to know that. Policy provisions. The loan rate, page 109, just highlight the top. Maximum loan rate is it's 8%. So when you borrow money out of your cash value policy, the maximum they can charge you an interest is 8%. All right. Assignability, we talked about that early on in the chapters. You can assign your policy over to somebody else as owners. There's two types. Collateral, which means you what? Collateral assignment means you own partial. Hold this until I pay you back. And you got an absolute assignment, which means you gave up the whole thing. Your all rights. Right? Collateral assignment versus an absolute assignment. Page 110. Suicide exclusion. If you're going to kill yourself, you got to wait at least how long?
A year.
1 year. War in aviation. The result of flying an airplane.
You don't get paid.
You don't get paid. That's if you flew it yourself. Not if you pay as a fair parent passenger. You find your own commercial plane. You out there having fun. That exclusion is on the policy. You won't get paid. If you die, remember it's a war. If you die as an act of war, remember there's a cause right? They declare war on America, then you don't get paid.
Right.
And then there's a status. Status means you active duty military and died while you was active duty military. You don't get paid. That's if that exclusion is on there. All right, remember that. Grace period is how many days?
31.
31 days. Incontestability, where you can contest not paying because somebody lied, is how many years? They lied on the policy. We ain't got to pay if you die within
2 years.
2 years, right? If you lied, when we found out you died within 2 years, we ain't got to pay. We just give you back your
Premium.
premium. Suicide is 1 year. Contestability is 2 years. Grace period is 31 days.
What was 30 days?
That's 30 or 31. They ain't gonna try to trick you. You're gonna be one or the other. Yeah. All right. How often do you got to renew your insurance license?
Every
Every 2 years.
How many hours of continuing education?
16.
How many of those in ethics?
3.
How much does it cost?
$100.
$100. That's what you got to remember.
Okay.
If you don't renew your license in 12 months, it expires. If you're late, every month they charge you
$25.
$25 a month.
I thought we had a grace period, like once we didn't pay
Once you didn't pay, yeah, you got a grace period.
that 31 or 30 days.
12 a year.
You got a year, but you got to pay $25 every month that you're late.
Right.
Because it costs $100 to renew your license, but if you renew it 4 months late, it costs you $2.
No, but it was like if I miss a payment.
Oh, that's for your life insurance policy.
Yeah.
Yeah, that's 31-day grace period. Yeah,
Gotcha.
anytime a policy gets lapse, no matter what, they got to give you a 31-day grace period, right? All right, so we got that part. Let's go over the credit life insurance. It's real easy. Credit life insurance, page 111. That means that somebody borrowed money from somebody. So if I loan Vincent $100,000, I can take out a life insurance policy on him. Because if he die, I can lose $100,000. So I got to show up interest in him because if he die, I can lose something of value, which is money, right? But I can't insure him for $200,000 because if I insure him for $200,000, I'm gonna kill him
Right.
because all he owed me is $100. But I'm gonna get $2 if he die. So as the balance goes down on what he owed me, so does the face amount. So what kind of term policy would that be? The face amount decreases. What kind of term is it?
Variable.
No,
Or
the face amount decreases. It's decreasing term.
decreasing term.
Right? Remember on term, all the premium stays level, the face amount goes up or down. Increasing term goes up. What goes up? The face amount. Decreasing term goes down. What goes down? The face amount. When would you use decreasing term? When somebody owe you money, a mortgage, personal loan. I can't insure you for more than what you owe me.
Okay.
That's what credit life is. On credit life insurance, the person that owes the debtor, the person that owes somebody, you don't even own it, and you ain't the beneficiary. You just pay the premium. So if you borrow money from me, I'm gonna take out a policy on you. I own it and I'm the beneficiary, but you pay the premium. Credit life. That makes sense? So the owner and the beneficiary is the person that loaned the money to you.
Say that
All
one-
you do is pay the premium.
Say that one more time.
I loaned you $100,000.
Right.
You got to get life insurance on you in case you die.
Who's paying the premium?
You are. You
See,
owe
I
me.
owe you.
You owe me $100,000. You gonna
And I
pay
gotta
premium.
pay the premium.
Yeah. That's right. I loaned you some money, $100,000.
Okay.
I don't know if you're gonna die. So the only way I'm gonna give you my $100,000 is you make sure I'm gonna get my money whether you live or die. So you gonna pay the premium on that. That makes sense. You took out a car insurance. You took out a car insurance loan, right? You got to buy car insurance. Who pay the premium?
Me.
Yeah. Who get the money when the car get totaled out? There you go. it's all the same. So you want to put it to your everyday life. That's what helped me remember it. Like you asking those questions because you got to parallel it to your regular life. I got to think about something that's outside of this that I'm already dealing with. You see what I'm saying? That makes sense. That's how I learned this stuff.
Right.
By asking a bunch of questions like you do, and I'm trying to put in my mind, what do I deal with everyday life that kind of work like this? I remember like car insurance, I pay my own premium. But if I told out my car, I got to go back to the company. Credit life insurance. I got the credit. I pay the premium. But I ain't the beneficiary or the owner.
Right.
Make sense? Variable products, just remember if you got variable products, that means it's tied to the stock market. If you got a life insurance policy called variable whole life, variable universal life, the word variable means it variates. No guarantees. You can have $100,000 in that a day and the stock market crash, you got no dollars in that or more. Variable products, that means they variate up and down, no guarantees. All right? So in order to have a variable, in order to sell variable products, the company got to have a surplus of $2.5 million. I like that. They're going to try to tell you $3 million. It ain't $3 million, it's 2.5. So for any insurance company to sell variable products, they got to have $2.5 million in surplus capital in reserves, $2.5 million. And any agent that want to sell variable products got to have a life insurance and a securities license. You got to have that investment license called a securities license. So to sell a variable product, you want to sell a variable whole life, variable universal life, then you got to get that second license. Does that make sense? Variable products. All right. Page 112. We'll go over suitabilities of products. You can read that in your own time. It's not gonna be too much of a test. Reports and examinations, right? That the examiner can audit you anytime they want to. They gotta do it at least once every 5 years. We don't gotta go with mandatory provision. I'll give you a little synopsis on this graded debt benefit on page 113. It's only gonna be 1 or 2 questions on the whole test, so don't try to master it. Graded debt benefit just simply means somebody gonna die. We know they're gonna die before we write the policy up. They unhealthy. They're adverse risk. So your adverse risk, we can still get you insurance, but not as much. And there's some clauses to it. So a graded debt benefit says that if you die in the first so many years of the policy, we ain't gonna pay the debt claim. We'll give you your money back and maybe some interest. But that policy has to be backed by accidental debt policy, which means that if they die by accident, it had nothing to do with why we graded them. You die by accident, we're gonna pay the full debt benefit. So if you die by accident the first year, we're gonna pay it all. But if you die because of this cancer that you got, then we may pay in the first year your premium back plus some interest. Second year, we may pay you back a portion of your debt benefit. If you had $10,000, we'll pay you $3,000. And by the third year, we'll pay you $5,000. After the third year, we'll pay you it all. So it's on a greater scale. The longer you got it, the more we'll pay out. Does that make sense?
Gotcha.
So that's what you think about on graded debt benefit. That if you die by accident, they pay it all. Now there's different variations of if you're 65, they do this, and if you're 75, they pay that. I don't get into all that because it's gonna be 1 or 2 policies on the test. You can read it on yourself. You want to break all that down. I never understood it because I didn't want to, and so it's 1 or 2 questions on the test. You think you need those 1 or 2 answers, you better master it. But that's it. So what you want to do from this point, guys, is again, what you do from today on is what's going to determine if you're going to pass this test or not. So I admonish you that every time you get downtime when you're driving and stuff, the video should be playing. Got that thing going, or that, you know what I'm saying? You got to make sure this stuff stay in your ear. Repetition, the more you hear it, the more you hear it, the more you see it. But every night you got to be on those practice tests. You got to take chapter 1 3 times, get a high 70, 80%. Chapter 2 3 times, high 70, 80%. Then tomorrow, chapter 3 and 4, right? And then Thursday, 5 and 6. By Friday, you need to be taking that full exam and passing the full exam with a green light. Now you know you're ready to take the real test. You should be taking that real test Saturday or Monday at the latest. Knock it out. Get it done. Does that make sense? And then you rock and roll.
Where do you take it at?
They're going to give you different addresses. So they got several locations in Missouri. You give them your address, they're going to tell you the one closest to you. And then you say if that was good, they got the availability, then you use that one. If they ain't got the availability, you go to another one.